Hello and welcome to another tutorial video. This time we're going to go back to startups and venture capital, and I'm going to explain how some of the most common terms in venture capital deals like liquidation preferences and participating preferred stock affect all analysis and how they might potentially affect you even if you're in investment banking and you have to advise one of these companies. Now you can find many explanations online about these types of common terms like liquidation preferences. But what I want to do here is explain how these terms are actually relevant in corporate finance roles such as investment banking, maybe growth equity, private equity, fields like that, and to go beyond venture capital and show how they might affect you in other areas. This is going to be a very quick introduction or summary of a very broad and deep topic. There are entire books just written about venture capital deals and deal analysis. So I'm going to give you the short version here and touch on the most important points. I'm going to go through a simple Excel example with two venture capital firms investing in a startup and then explain how some of these deal terms might change their outcomes. You can see the Excel file here. We're going to track this company through a Series A and B investment round. We will look at an exit analysis with liquidation preferences factored in. Then we'll look at an exit analysis at a different selling price with liquidation preferences and participating preferred stock and participation caps included as well. I'm going to start with the short answer, as always, and then we'll get into the detail and some of the Excel modeling here. If you assume that VC firm A and VC firm B each own 25% of a startup, the startup gets a $100 million acquisition offer, and the startup accepts the offer, you might think that VC firm A gets 25 million of the proceeds and VC firm B gets 25 million as well. So it'll look something like this pie chart at the bottom, and it's split up according to ownership percentages. But that won't necessarily happen. The distribution of proceeds could easily be different than the VC firm's ownership percentages, because when VC firms invest in startups, they almost always do that by purchasing preferred stock, not common stock, which means that they get additional rights, privileges, and terms. And if they want to, they can convert their preferred shares into common shares for the equivalent ownership percentage, which almost always happens in IPOs, initial public offerings, or in very large and favorable exits for everyone. But if you get an exit scenario where the VC firm could earn more by keeping their preferred shares, they will almost always choose to do that instead. So in a $100 million exit, you could easily have a case where even though VC firm A and B each own 25% of the company, VC firm A gets 25 million, but then VC firm B gets 40 million. So you get this type of skewed pie chart where it's not quite as simple and straightforward as the first example, where it looks more like this instead. Virtually any other split here is possible, and it really depends on the dollar amounts the VC firms invested, the valuations at which they invested, and then the liquidation preferences, participating preferred terms, participation cap, and other terms that are attached to their investments. In investment banking, these deal terms matter when you are advising startups and also private companies that have raised outside capital, because they will affect the appeal of various exit options. And so you might recommend an IPO to one company, but then for another company, maybe you recommend an M&A deal or some other type of exit option. For example, company management may not want to accept a subpar acquisition offer because it means less in proceeds for them because the VCs have such favorable deal terms. They may want to stick it out and build the company and go for an IPO in 5 or 10 years or something like that. But the VC investors might see the writing on the wall and they might want to just exit ASAP so that they can earn some of their money back and then focus on companies that are doing it a bit better. They probably don't want to roll the dice and wait 5 to 10 years for the company to grow and become more valuable in a potential IPO. And so you could get these types of conflicts, which are often rooted in the fact that the investments were made on different terms, and the terms that VCs have in deals are not necessarily shared by the founders and the management and the employees of the company. With standard public companies, these points still come up because all the common shareholders are treated the same way. Even if the company has multiple share classes, you can always convert them into one single share class based on the conversion factors. And even if you have debt or preferred stock or other types of capital in the company, those investors simply get paid first based on fairly simple rules. You don't have to go through this complicated process of unpacking which type of equity investor gets paid the most and what happens if the deal price is under a certain level. None of that really comes up when you're dealing with a traditional public company. So I'm going to go through the lesson overview now, and then we'll get into the Excel detail here. First, I'm going to start with company ownership in the Series A and B rounds and show you some simple examples of how to calculate this. Then in part 2, we'll go into the concept of liquidation preferences, and I'll show you how to calculate some of those and determine the exit proceeds. And then in part 3, we'll go through the participating preferred stock concept and calculations for that, and I'll show you how it affects deal outcomes even when a company gets sold for a higher price that is better for the investors. Let's go to part 1 and talk about the company ownership calculations. Now, I'll say upfront that this is an extremely simplified example because I just want to illustrate the basic concepts. So we're skipping over things like employee option pools and stock grants and additional ownership purchased by previous investors in the current round, for example. The Series A round here is usually the first significant outside investment in a startup, which is there to help it attain product and market fit in most cases. And then the Series B round usually happens when the startup has some type of product that the market likes, and now they need to scale and they need to sell and market more effectively. This tends to be bigger and it tends to be done at a higher valuation, and it's usually done by somewhat later stage investors as well. The most important point here is that when you calculate the number of common shares after each round takes place, it's equal to the previous common shares divided by 1 minus the new ownership created or granted in this round. So let's go into Excel now and see how this works. We have 5 million shares before any VC funding takes place. The Series A round is $5 million. It's done at a $10 million pre-money valuation. And so the post-money valuation is whatever the VCs put in plus the pre-money valuation. These correspond to the concept of equity value. So after this takes place, the company's enterprise value is the same because their equity value has gone up, but then their cash balance has also gone up. So the enterprise value here stays the same, but the equity value changes. And that's what the pre-money and post-money valuation concepts always refer to. Now, for the ownership percentage here, we take the investment size and we divide by the post-money valuation. So it's 33%. And then for the number of shares after this round occurs, we take the number of shares from before the round took place and then divide by 1 minus the ownership percentage. So we effectively boost up the common share count by however much in ownership was granted or created in this round. We get to 7.5 million shares. We also see that the Series A investors had a 1x liquidation preference here, which is something we'll get into in the next segment. But for now, I'll fill this in by taking the investment size and multiplying by this, and we'll get into what this means and how it works in a little bit. Now, in the Series B round, by this point, the company has grown, expanded, and it needs more capital to keep selling and marketing and growing its business and getting more customers. So this is usually done at a much higher valuation. We see 60 million here versus 10 million in the Series A round. The post-money valuation is the same calculation, the investment size plus the pre-money valuation. For the ownership, we take the 20 million, divide by the 80 million. So it's 25% here. And then for the number of new shares after this round takes place, we take the number of shares from before the round took place, divide by 1 minus the ownership percentage. And then for the Series A investor post-money ownership here, in the first round, they got 2.5 million common shares. We can take the share count from after it took place, subtract the share count from before it took place to get that number. And then we just divide by the new share count after the Series B round here. And we see that both investor groups now have 25% ownership in this startup after both rounds have taken place. Once again, we have a liquidation preference. I'll just fill this in for now, and we'll get into the explanation soon. So the Series B investors have this $40 million liquidation preference. Let's go to the next part now and actually get into what these liquidation preferences mean. The idea here is that if a VC investor chooses to keep its preferred stock, it will receive a fixed dollar amount whenever there is a liquidation event, such as a sale of the entire company, a change of control, a bankruptcy or shutdown, something like that. Notably, this does not include an IPO. That's not considered a liquidation event. It's considered more of a financing event. Now, obviously, if the company sells for $5 million and there's a $10 million liquidation preference, the investor can't possibly get that. So they would only get $5 million in that case, which is why I write right here up to the amount the exit proceeds can cover. So there is a limit here, and it's really based on the selling price of the company. Now, this liquidation preference is almost always a multiple of the initial investment from the VC. It could be a 1x multiple, which is by far the most common one in most market environments, but you could have 2x, 3x multiples, sometimes even up to 10x, which has happened before in somewhat crazy environments, such as right after the dot-com bust in the early 2000s. If the exit proceeds cannot pay for each VC's liquidation preference, then they get paid in order of seniority, typically with the latest stage investors. So the Series B investors here getting first priority, and then moving down to the Series A investors, the seed investors, and anyone below them. There are variations and there are different ways to calculate seniority, but we don't really have time to get into all that here. I'm just going to show you the basic idea for how this works. The purpose of liquidation preferences is to protect VCs from scenarios where they invest in a company when it's valued at $100 million and they get 20, 25% ownership, something like that. And then the company sells the next month or the next year for $80 million. In this scenario, the VCs really lose out because they just put in money and the company didn't even really use it, but then they suddenly decide to sell at a lower price. So the liquidation preference, at least at the 1x level, provides protection from this type of outcome. Now, to calculate the liquidation preferences in Excel and to make some decisions, if there are only a few investor groups and you only have liquidation preferences with no other special terms, it's fairly straightforward. You start by calculating each VC firm's exit proceeds if they were to convert into common stock. Then you pay out the greater of these common stock proceeds or the liquidation preference to each VC. So you're essentially seeing if they are better off converting into common shares or staying in preferred stock to collect their liquidation preference. And again, you have to limit this based on the proceeds that are available. So if you have a $5 million sale, you can't pay out $20 million in liquidation preferences. You're limited to the $5 million. Once you've done that, then everything left after these payouts goes to the common shareholders. So the founders, the management, the employees, parties like that in the company. So let's go into Excel and see how this works. I have the information down here in this second area. Let's bring in the dollar amounts of these investments first, so we have them for our reference later on. And then let's bring in the liquidation preferences, which we calculated before. It's a 1x preference for the Series A investors, and then a 2x preference for the Series B investors. For the ownership percentages, here we can go by these percentages after the latest round. So we know Series A has 25%, the Series B investors also have 25%, and the common shareholders just have 1 minus whatever the VC investors have, so 50% here. Now, for the exit value if converted, for this one, we go and just take the ownership percentage right here and we multiply by the company exit value. We're assuming 100 million for this example. We copy this down. And then we can look at something called the conversion threshold as well. This is equal to the VC firm's liquidation preference divided by their ownership percentage. And this basically tells us at which selling price it would be beneficial for the VC firm to convert into common shares rather than staying in preferred stock. And again, it only really works if you have a very simple structure where there are liquidation preferences and pre-money, post-money valuations, investment amounts, but nothing special, no other special terms here. Let's go down now and see what this looks like. So for the exit equity value, we'll link up to this 100 million right here. And then for the Series B investor proceeds, the first thing we have to do is use a max function. And we want to take the liquidation preference for the Series B investors, and then we want to compare it to the exit value if converted. So this corresponds to what I was talking about before. We always compare these two and we take whichever one is greater. That's the liquidation preference in this case, at least at this $100 million exit value. However, it's not quite that simple because we could end up in a scenario where the exit value is less than the $40 million liquidation preference. So to handle that case, we have to add a minimum function in front of this, and then we have to compare this to the exit equity value right up here in the line above, right there. And I'm going to put a negative sign in front of this whole thing so that this appears as a deduction. We'll add these up, and this gives us our proceeds remaining for the Series A investors and for the common shareholders in the company. The idea is very similar for the Series A investor proceeds. We'll start by taking the maximum between the liquidation preference and the exit value if converted. And then we need to use a minimum function once again. So we'll take the min between the proceeds remaining right here, and then this whole thing in the max function, and I'll put a negative sign in front. And then we'll subtract these to get the proceeds to the common shareholders. And then down here, you can see our exit proceeds split. And this is exactly what I was referring to in the earlier slides. Even though on paper, the Series B investors own 25% of the company here, because of their liquidation preference, they actually get 40% of the exit proceeds. And that is one big impact of liquidation preferences. Now, another big impact is if we set the exit price to be much lower. So let's make it, say, 45 million. Well, now the Series B investors get back their liquidation preference. They earn their liquidation preference. They get a 2x multiple of invested capital. The Series A investors also get their liquidation preference back, but they get nothing more than that. And so they get a 1x multiple of invested capital, and then nothing goes to the common shareholders. Now, if you change this to a much higher exit value, say 450 million, in this case, both investor groups are going to convert to common stock, because when the company exits for a very high value like this relative to its previous valuations in previous funding rounds, then usually it's going to benefit all the investors. It's going to be best for all the investors to convert into common stock. So that is how liquidation preferences work. I'm going to change the exit value back to 100 million here for now. Let's now go to the next concept and talk about participating preferred stock, how this works, and how the calculations are a little bit different. The idea here is that with participating preferred stock, the VC firm keeps its preferred stock. So if it chooses to remain in preferred stock, it still gets its liquidation preference, but then it also gets to participate as a common equity investor by taking a percentage of the proceeds remaining after they get the liquidation preference payouts. In essence, participating preferred stock is a double dip that allows VC firms to get the best of both worlds. They recover their initial investment, but then they also get more on top of that. This term heavily skews the deal and the exit proceeds in favor of the VCs, and for that reason, a lot of entrepreneurs, founders, managers do not like to see this at all. If this term exists, there is usually a participation cap. It could be 2x, 3x, sometimes more than that, depending on the market, and this limits the VC's total proceeds to a multiple of their liquidation preference in most cases. So it's not based on their initial investment, it's usually a multiple of their liquidation preference. This just ensures that they can benefit to a point, but if it becomes a $10 billion or a $100 billion company or something like that, there is only so much they can get, especially if they were a late stage investor. They came in at the last minute. They didn't really take that much risk. This participation cap ensures more of an equitable outcome for all parties involved in the deal. Now, the calculations here get more complicated because you have to plot out the different conversion options to determine the optimal set of decisions. It's not as simple as just setting up a quick min-max function or something like that. And especially when you have, say, 5 or 10 or 15 different investor groups, it can get very complicated. You start by calculating each VC firm's exit proceeds if they convert to common. You fill in other terms that may be relevant as well, like the participation cap. Then you calculate and deduct all the liquidation preferences from the exit proceeds based on whether each group stays in preferred stock or converts to common. Then you calculate and deduct the participating preferred proceeds based on the conversion decisions and the participation caps. Once you've deducted both of these for the preferred stockholders, then you recalculate the common shares and the ownership, because some of these groups will be gone now. They won't be common shareholders anymore because they'll have already been paid. And then you distribute the remaining proceeds to the common equity investors based on their ownership percentages at this stage. That is a lot of words, so let's take a look at this in Excel and see how the mechanics work. So let's go down here, and I've already filled in some of these links here just to save us a bit of time. For the common share equivalents, so we have to calculate our ownership percentages here. For the Series A investors, let's go up and use the number of shares after the round and subtract the number of shares from before the round. For the Series B investors, we'll do something quite similar. And then for the common shareholders, we'll just go up and take the common shares from before any VC rounds here took place. So now we have all of our ownership percentages here. For the exit value, if converted, we just take each ownership percentage and multiply by this 250 million, copy this down, and then add this up. And you can see I've already set some assumptions here. The Series A investors will not have participating preferred stock, but the Series B investors will. They have a 2x participation cap, and they're not going to convert to common. The Series A investors are also not going to convert to common. We might as well also fill in the participation cap while we're at this. So I'll take the 2x and multiply by the liquidation preference, and we get an $80 million cap, which means that when these Series B investors invested the 20 million right here, they can earn a maximum of 80 million here if they stay in preferred stock, when an exit or shutdown takes place. Let's start by filling in the exit equity value, the 250 million here. We're going with a higher price so I can illustrate some different dynamics. And then for the liquidation preference, it's pretty much the same idea that we had before. I'll start by entering a min function here. We'll take the exit equity value. Again, this is to make sure that we actually have enough to cover whatever the liquidation preference is. And then I will go over and we want to check the Series B investors here. Now, if they are not converting to common, so if this is set to 0, then we want to enter the liquidation preference right here because this is what we should be comparing. And if they are in fact converting to common, then this is just going to be 0. And so there isn't really a comparison here because it's more of a check to see if they are converting to common, not whether they should convert to common. Let's add these up and then get our remaining proceeds. And then for the Series A investor proceeds from the liquidation preference, it's the same exact idea. So we'll use a negative minimum and we'll look at the remaining proceeds and then we'll just do a check. And if we are not converting to common, so if they're staying in preferred stock, then we're going to enter the liquidation preference right here as the comparison. Otherwise, we'll just say 0. We have that. And then can add these up to get our remaining proceeds. Now, for the participating preferred stock next. So this is where it gets a little bit more complicated. The formula looks somewhat complex, but it's mostly because we have to check for a lot of conditions here. I don't think it's actually all that complicated if you break it down. Let's start this by actually entering a min function. And what we want to do here is go up and look at the participation cap first, and then we have to add to it the amount that they've received so far from the liquidation preference. So the idea here is that we're taking this participation cap, we're effectively subtracting whatever they've gotten from the liquidation preference, and this is however much left they can receive here as part of their participation in this deal. So we have to compare this to the remaining proceeds right here, and then multiply by their ownership percentage up here. So essentially, this part handles the cap. We're looking at however much they can receive up to this $80 million amount, and then we're looking at the 25% times however much is remaining, and then we are granting them whichever one of those is less, and we're effectively capping their proceeds like that. Now, it gets more complicated because we have to add some other terms and conditions here. First of all, we have to do a check, and I'm going to enter an isNumber function here, and we want to see if there is an actual participation cap before making this assumption. So if this is actually a number, meaning there is a participation cap, then we will have this whole function that I just entered. Otherwise, we are just going to assume the ownership percentage times the remaining available proceeds here. So this handles the case where there is no cap. It's simply participating preferred stock with no cap at all. So we have that, but then we need to add something else in the beginning, which is to check and make sure that they have not actually converted into common stock at this point. So I will enter a negative in front, an if and an and then we will go up and check to see if they actually have participating preferred stock, and also to see that they have not converted into common stock. So we want to check to make sure that M65 is 0. We have all that, and then here at the end, if one of these first two conditions, so if this whole set of conditions in the and is false, then we're just going to say 0 because they cannot possibly have participating preferred stock in this case. And I forgot a parentheses right there. So I fixed that, and Excel is now accepting this as a correct formula. The Series A investors, the participating preferred share, it's exactly the same idea. So I'm just going to enter this formula from start to finish because I've already explained exactly what it's doing. We want to check first if they actually have participating preferred stock, which they don't in this case, and also make sure that they have not converted into common stock. And then we'll do this if is number check and see if they actually have a participation cap. If they do, then we take the min between this cap minus the amount that they have actually received so far, and we compare it to their ownership percentage times the amount of remaining proceeds down here. And then if there is no participation cap at all, we just take the ownership percentage and then multiply by the remaining proceeds right here. I'll close these out, enter a 0 if the first set of conditions is false, and we have that. So let's add these up and get our remaining proceeds down here. And then for this last part, to determine the common equity proceeds, we need to look at the ownership now. Let's start with the Series B investors. And the reason why I entered the common share equivalents is so that we could set up something for this part of the process. We'll take these common share equivalents and then multiply by the convert to common switch. If this is 0, then these common share equivalents will go to 0 because they stay in preferred stock. If it's 1, then we'll get the common share equivalents that they actually have. And then let's do the same thing above. We'll take the common share equivalents and multiply by the switch. And then for the common shareholders, they have no conversion option. They're always in common stock. So we'll link to their common share equivalents there. And then we can take all these and divide to get the ownership percentages. We have that. And then for this next part, for the common equity proceeds to each group, let's take the ownership percentage of each one and multiply by the remaining proceeds. I'll anchor that. We have this, and now we can add these up. And as expected, we get 0 for the total remaining proceeds. And you can see down here what happens. The Series B investors do very well. They get a 4x multiple. Even with the participation cap, they get 4 times their initial investment. So they do quite well in this deal. The common shareholders do really well. They get 165 times their initial investment. And the Series A investors don't really do that well. In fact, they basically just break even, which is a bad outcome for the amount of risk they've taken on. Now, of course, this is a bit of an artificial scenario because if this company actually sells for $250 million, the Series A investors are certainly going to convert to common shares. So I should change this to 1. And then we can see now they do significantly better. Now they get an 11x multiple. The common shareholders move down to a 113x multiple, still an incredibly good outcome, but not as good as before. And then for the Series B investors here, this is an interesting one because this is a moderately good selling price, but we don't know for sure if they're better off staying in preferred stock or converting to common. So let's try this right now. Convert to common, I'll set to 1. And you can see they're actually worse off in this case converting to common. Actually, we should have known that because the exit value, if converted here, was 62.5 million. So in this case, the logical thing to do would be for the Series B investors to actually stay in preferred stock so that they can get all 80 million of proceeds, which exceeds the 62.5 million they would get if they converted to common stock. Now, at much higher exit values, so let's say they exit for 2.5 billion or something in that range. In this case, it's such a favorable exit that the Series B investors would be crazy to stay in preferred stock because they only get 80 million, whereas they get 625 million if they convert to common. So in this case, they would obviously choose to convert to common, and you can see they get a much, much bigger return like that. In real life, you have to go through this type of decision-making process and you have to look at different scenarios. You would set up a more complicated Excel model that plots all the different possibilities. And in general, the optimal conversion decisions for the investors are the ones that minimize the proceeds to the common shareholders. If the terms are messy enough to the point where you need a very complicated model and decision tree to explain what's happening, then in a lot of cases, an IPO is simpler because in most IPOs, all the preferred stock tends to convert to common. So you don't get these types of conflicts because different investors have different terms. And you might recommend to your client an IPO instead of an M&A deal if there are messy terms like this and the proposed price in an acquisition is not so great. That's it for this lesson. Let's do a quick recap and summary. We started off by going over the company ownership in the Series A and B rounds. And I showed you some fairly simple examples of calculations here. I'm omitting a lot. There are no employee option pools or extra grants for executives or other things like that. But I just wanted to introduce the basic concept. Then we went into the concept of liquidation preferences and the calculations there. The good news is that if you have a case where there are only liquidation preferences and no other fancy or special terms, it's usually pretty easy to determine what the optimal decisions are for the venture capital firms involved. And you saw that here. We just used a simple min-max function to do it. And then we turned our attention to participating preferred stock and participation caps. You saw how these Excel formulas work. The one for the participating preferred share may look a little intimidating at first, but if you actually break apart each part, I don't think it's that complicated. A lot of it, frankly, is just doing some error checking and checking to make sure that they actually have participating preferred stock, checking to see if there's a cap or not. If you take those parts out, really it's just a minimum function and we compare two different quantities and pay out whichever one is less. And then you saw how different exit values could potentially affect the proceeds and also how different conversion decisions could also potentially affect the proceeds right here. So that's it for our lesson. Hopefully now you know a little bit more about venture capital deals, common terms like liquidation preferences, participating preferred stock, and participation caps, and you have some sense of how they might affect you if you are a banker or other advisor who is working with startups and you need to evaluate their exit options and give them some advice on what to do.